I'm Bob Landaas, president of Landaas and Company. Morning, everyone. My job as a money manager is to design, implement, and then manage investment portfolios. We're very interested in tailoring our advice so that everyone gets a custom portfolio based on their needs and wants and what's suitable for them. Against that backdrop, we also care about the economy. Financial markets, of course, are driven by economic forces around the world. So this morning, my job is to talk about current economic events here in the United States and overseas. I'll discuss the stock and bond markets within the context of global economics and outline possible and probable outcomes. Investing is a lot like sailing. You have to assess current conditions before you set sail, and once underway, you're always adjusting sail based on changing weather and seas. Because wind is invisible, experienced sailors learn to read the water for changes. Experienced investors learn to read the economy for their course corrections. This month marks the 5th anniversary of the financial crisis. We've come a long way since then. We started the year with the threat of going over the fiscal cliff, faced dire predictions of an imminent recession. Of course, we avoided all that. We avoided the recession as well. And after experiencing sluggish growth, the economy, in my opinion, has improved lately along with the outlook. Headwinds that have been holding the economy back are now becoming tailwinds, and folks, these are becoming significant. Consider housing had been subtracting 1% from GDP of each of the last 5 years. Housing now is anticipated to add 1% to growth, a headwind becoming a tailwind. Debt repayments, I'll be talking about that in detail, and part of that is because of foreclosure, bankruptcies, but debt as a percentage of disposable income is right now at fairly low levels. And corporate cost cutting, of course, dramatically impacts corporate profits. Profits are the highest they've ever been here in the United States. Now, as many of you know, much of the sluggish growth this year was a result of fiscal policy, as government spending cuts and tax increases weighed on the economy. These drags are waning now as the year moves on, setting the stage for better growth. Budget cuts and tax increases since the start of the year lowered the pace of economic growth by about 1.8% in the first half of this year. Forecasts for the rest of the year, in my opinion, are pretty encouraging. 2.3% growth in the current quarter, 2.7% growth in the fourth quarter. A recent survey of economists published in the Wall Street Journal put the odds of a recession in the next 12 months at less than 15%. That's the lowest you ever see in those types of surveys. The consensus forecast for next year is 3% growth in the United States, getting closer to the long-term average of 3.4%. The bottom bullet point here is a big deal. Many forecasts over the last 5 years suggested that inflation was going to skyrocket because of government spending. We contended that with banks not lending money, the multiplier effect being broken, there was no way that inflation was going to rear its ugly head. And as we all know, year over year, through August, inflation was extremely low at 1.2%. I've tried to convince you folks over the decades that there are two things that cause stocks to go up and down: interest rates and earnings. Interest rates, of course, are fueled by inflationary forecasts, and with low inflation now, the forecast for just gradually higher interest rates in the future, I think, is a pretty good call. A year ago, the U.S. was averaging just 130,000 new jobs a month. In the last 6 months, we've added 180,000 new jobs, and unemployment has fallen to 7.3%. A point lost on many is that we're now back to re-leveraging. Okay? Banks, companies, and individuals aggressively scaled back borrowing after the financial crisis. Some experts say that deleveraging is over and re-leveraging is well underway. Corporate leverage, a measure of financial risk, has returned to pre-crisis levels. Rising debt and leverage are signs of renewed market confidence, in my opinion. The financial system is in much better shape now. Tier 1 capital, an important measure of bank health, has risen from under 10% in 2008 to 13% today. The banks have recapitalized and capital standards are up. Housing construction, as I mentioned, is one of the bright spots in the economy, growing now at an annualized 12% rate. Home prices are also up 12% compared to a year ago. While mortgage rates have climbed recently, looser lending standards may help to offset the higher rates. Exports, that's a big deal. So we see that as buried inside the GDP report that comes out every 90 days. Exports are booming right now. They're up 8.6% as of the second quarter of this year. Manufacturing is another bright spot, coming back from the phoenix rising from the ashes, if you will. New orders are at their highest level in 2 years. The latest report shows that manufacturing output could strengthen in the coming months. Car sales, that caught a lot of people by surprise. They've now surpassed their pre-recession levels. They're up 17% from a year ago. And consider that Buick remains the best-selling car in China for the fourth year in a row. So the overall economy accelerated in the second quarter to a degree that was even better than expected. There are two things that I've been telling folks for the better part of 2 years where I usually elicit some kind of response like, no kidding, or really? Here's one of them. So look at the arrow on the right-hand side of this chart. Folks, what you're looking at is gross domestic product. It's the broadest measure of goods and services produced here in the United States. The U.S. economy is the largest it's ever been, and that's existed since June of 2011. So for over 2 years now, goods and services produced here in this country are setting record levels. Unemployment's been coming down. Granted, part of it is people just flat out give up looking for work. But the unemployment right now is at 7.3%. And we've come a long way since the days of 10% plus unemployment in the depths of the Great Recession. So this is one of my favorite measures of inflation, also buried inside the GDP report that comes out every 90 days. This was Alan Greenspan's favorite measure. As many of you know, there are just 13 components for the Consumer Price Index, this personal consumption expenditure index, a little bit more accurate way to measure inflation. And not to belabor the point, but inflation is very, very low right now. Consider that the Fed is trying to create a 2% inflation rate here in the United States, and it's just barely above 1% now. But as you can see, the 50-year average for inflation in the United States is 3.5%, and we're just a fraction of that now. U.S. budget deficit as a percentage of GDP, that number is coming way down. Consider that as recently as February of this year, experts forecasted we'd be about $825 billion in the red for the fiscal year that ends next Monday. Recent studies showed that they think the number is going to be somewhere north of $640 billion. So we're coming way down as a percentage. Think of the 2.2 million jobs that have been created in the United States in the last 12 months. These folks are all paying income tax into the system, helping to bring the deficits down. As an aside, it's always amazing to me that when you have a room full of economists, the deficit never comes up in conversation. And the reason is most folks realize that it's a solvable problem. They're going to means test Social Security and Medicare at some point down the road, and that'll bring the deficits down. So this is an interesting chart. It talks about household debt service, 40-year average. As you can see, 12%. This is of your disposable income. How much of your income are you using for debt service? We hit a low of 10.3 just last year, and the number's just barely coming up. Economists talk about the conundrum of savings. The more you save, the less you spend, and the weaker the economy is. So folks for the last 5 years have been dramatically paying down their debt. That holds back retail spending, of course, and now it's starting to go the other way, a headwind, becoming a pretty significant tailwind for the U.S. economy. So I mentioned earlier, housing had been a significant headwind to the economy, and now prices are up, inventories are down, and we see a 12-month change in home prices, the Case-Shiller numbers that get published every couple of months. Corporate cash as a percentage of current assets is almost at a record. And this is a big deal in my opinion. Business spending is finally picking up. You got to have the cash to spend the money. We talk about capacity utilization all the time. It's the amount of plant and equipment currently in use in the United States. We're at 78% of capacity. Studies show that once we hit 81% of capacity, there are bottlenecks and supply pressures in the pipeline. As a result, inflation starts going up. And that's generally what triggers business spending for new plant and equipment. The point is you got to have it to spend it, and companies sure have it right now, sitting on almost record piles of cash. So, of course, you got to worry about a few things here. One is the possible showdown in Washington over the spending and debt limits. Hopefully they'll have the good sense to put the pin back in the hand grenade. Ben Bernanke, in testimony in front of Congress on May 22nd, thought that the greatest threat to the U.S. economy was the U.S. Congress. That's pathetic, in my opinion. Slowing growth in China, we'll talk more about that when I shift over to international stocks. But the gist is China has slowed dramatically down to a 7% growth rate. That's the lowest since 1990. It's impacted all sorts of issues. Iron ore shipments from Brazil, coal shipments from Indonesia to China is another example where the emerging markets are suffering. And the last bullet point, it seems that they're making some progress with Syria now. For all the years that I've been alive, we've had problems in the Middle East. I don't know that we'll ever be done with those problems, but it has caused oil prices to go up this year. Of any of the major commodities groups, oil's the only one that has gone up. We know that oil directly impacts the cost of gasoline, and it directly impacts consumer spending. So those are three of my worries short term. We've seen a big shift in the economies this year. The new normal didn't last long. During and after the financial crisis, developing nations tended to do better than the developed world. Many nations avoided a real estate bubble and a collapse and a banking crisis. These countries had surpluses and citizens without large debts. The new normal, of course, predicted that the emerging economies would lead the world in economic growth into the future. The future lasted 5 years. In the last few months, the tide has turned. The developed world, that's U.S., Europe, and Japan, is now producing more than the emerging markets. Manufacturers and service companies are reporting growing business in developed countries compared to the developing countries. For the first time since 2007, the advanced economies of the U.S., Europe, and Japan are contributing more to global growth in the $74 trillion global economy than the emerging nations. This turnabout is changing world capital flows and is challenging traditional asset allocation assumptions. A couple reasons for this. One is that the nature of the U.S. expansion was different. In past recoveries, it was led by consumer demand. This pent-up demand, we're going to wait to buy a new house, we're going to wait to buy a new car, we're going to wait till we get more hours at work until we remodel the house. When the economy starts to turn, this trough that we surge from gets the U.S. out of recessions. So this last time around, consumers absolutely played no role in the recovery. A lot of it was domestic energy production. We don't import oil equipment. It's all made here in the United States. And as a result of the explosion in fracking, a lot of people can point to that and say that really had a big part in the recovery, and now, of course, with housing turning the corner. Second point is Japan, after all these years, 21 years, that's unbelievable, of deflation and sluggish growth, they're finally growing. Shinzo Abe, the new prime minister, is doing a wonderful job of getting the economy going again. We know that Japan's economy grew at 3.4% in the second quarter. That was double the rate of growth here in the United States. And then finally, the recession is over in Europe for now. You know, all these years I never knew I had to worry about Greece, never knew I had to worry about Cyprus. And for a number of years, we've all been struggling with, is Germany going to bail them out again or not? Is the International Monetary Fund going to open up their checkbook or not? Arguing about austerity and bailouts. And now Europe, at least Western Europe, is recovering, and they're now expanding and no longer in recession. Some other forces driving the global shift, you got to point to interest rates. Rising interest rates in the U.S. has squeezed credit in many parts of the emerging markets. Earlier this summer, the bonds, the currencies, and stock markets of many developing nations have been hit in recent times as investors brace for an end of bond buying by the Fed. The Fed's low interest rates over the last 5 years sent money pouring into the developing world as investors chased higher yields. Now that trend has reversed as interest rates head higher. Growth in Russia, Brazil, India, and China is slowing after a period of really strong growth. And as I said, much of the change can be traced to China. China's reduced demand for commodities like iron ore, copper, and coal has affected Latin America and Southeast Asia. Emerging nations are raising interest rates now in an effort to stem an exit of cash in a trend that threatens to intensify, in my opinion, an economic slowdown in the developing world. So after all these years of being told that the developing world was going to lead the world markets, we're now seeing it switch over. And as I said, the developed world now commands the majority of production in the world. So despite tax increases, sequestration, the Fed's intention to taper its bond buying, the U.S. economy, in my opinion, is surprisingly resilient. Western Europe and Japan are also showing signs of recovery. International Monetary Fund forecasts the global economy to expand 3.3% this year, largely because of improvements in the developed world. You know, I say this every year, so here we go once more. This is my all-time favorite chart. It's important that we all stare at this for a while this year because bonds are under pressure. Many folks are going to be tempted to get rid of their bonds and increase their stock exposure. And my point simply is everything in moderation. So just for the record here, look at the lower left-hand part of this chart. You see the blue balloon, 100% in bonds. So X and a Y axis on the left side, that's your return. The bottom is volatility or risk. So it's pretty interesting to see that the blue balloon is the lowest return, 100% in bonds, but not the lowest risk. So a pretty good horse trade, if you increase your stock exposure to 20%, I've actually reduced your risk and increased your return. What's not to like about that? You dial it up a little bit more to 40% in stock. I don't get to tell you anymore I've reduced your risk, I haven't. But look at that balloon where it's 40% in stocks, 60% in bonds. You get about the same increase in return commensurate with the increase in risk. Still a pretty good trade. So y'all know the punchline. You get much past 55% in stock, and your risk line keeps going up, but your return line flattens out. Right? And the point of all this is, on average, don't let your stock portfolio get much above 60%. Now, the problem with asset allocation is that, by definition, there's always going to be a part of your portfolio that's underperforming another part. And human nature being what it is, everybody meows about the part that's not doing well and wants to shift money over to the part that's doing well. And at the end of the day, it's all about balance. Any of you read the Journal Sentinel on Sunday, the Wall Street Journal supplement, where they talked about the lessons that people should have learned from the financial crisis? I mean, how about that for a dose of humility? That the head of the IMF, the head of the Federal Reserve, the heads of the 10 biggest banks and brokerages in the United States never saw it coming, right? My conclusion, number one, is I know as much as those guys do. And number two, what I conclude is that you're just not going to see them all coming. You know, I love telling people of the 8 major sell-offs since I started in 1975, nobody called 4 of them. Nobody, right? 9/11, how could you? The Persian Gulf crisis, the crash in '87, and the Arab embargo. Nobody called any of that. Now, plenty of us called the other 4, but not a great batting average. So half the point of this slide is that the academic studies reinforce what I've always taken as common sense. Behave yourself with almost half your money. Make it bulletproof. No ifs, ands, doubts, or buts. You can't get hurt with that part of your portfolio. And I'll be talking about bonds in a minute, but don't give up your safe money. And don't be doing the knucklehead things that investors are doing, chasing yield and going to lower quality. That stuff ended badly in the financial crisis. So this is my favorite chart of all time. It's interesting that if you go back over the years, that chart hasn't changed much, and it's a 30-year look back in the financial markets. Literally what they teach in business school, this concept is known as the efficient frontier. At what point, when you're increasing the risk of your portfolio, is the next unit of risk not worth the reward that you get? and it's one of the smartest things I figured out. Think about the years from 2000 to 2010. It's not that we all got clairvoyant and thought that bonds would outperform stocks. It had nothing to do with it. We understood the efficient frontier in modern portfolio theory, and we never would have thought for a moment that bonds would have outperformed stocks for that 10-year period of time. But it kept us out of trouble. We were more than able to support the normal 5% withdrawals that you folks take from your accounts, and it all has to do with this slide right here. So shifting gears to the stock market here for just a little bit, valuations are higher than a year ago, of course, but still remain attractive in a historical context. Typically, markets don't just end at fair value. This is an important point. You go back over history and you want to tag the tail end of a bull cycle, they don't end at fair value. Americans excel at going to excess, right? So markets end when every matrix is high. And as I'll show you in a bit, whether you talk about price to earnings, price to cash, price to sales, price to book, any of the traditional measures, stocks are either attractively priced or a little bit below average. In the second half of a bull market cycle, you usually get something called an expansion of the multiples. In English, what that means is PEs go up. And just PEs going, as I'll show you in a minute, we're at 14.5 times next year's earnings. Just getting to 16 times earnings represents a significant increase in stock prices. So as I'll show you in the charts, profits are the highest they've ever been. That's another one that usually elicits a response of, really? So we set a record back in 2007 at $88 for the S&P, operating earnings excluding negatives. This year we're going to end at about $110, right? So a significant increase in corporate profits from what we saw in 2007. Low interest rates, of course, favor equities. Real simple concept, folks. If CDs went to 10%, we'd all go, whoa, thank you, and stocks would get hammered. But with CDs currently paying less than 0.5%, well, there's no competition at all for stocks. You get a dividend 4 or 5 times that high just going into the stock market. We get asked this question all the time, is the Fed bond buying supporting the markets, and when they stop their buying, won't the house of cards collapse? And in my opinion, no, that's not going to happen. And the reason is, think of the analogy of the patient on life support. Ultimately, when that patient starts breathing on their own, they take them off of life support, and the patient does pretty well. The economy's been improving, and I thought it was interesting that Chairman Bernanke specifically pointed to Congress as the principal reason for him not starting the tapering, that he was worried about what they would do with the debt ceiling debate. So for our money, the stock market is going to fully reflect earnings over the next couple of years, and that the end of tapering, the end of this bond buying, won't get in our way. When you buy a stock, you get a piece of the earnings, and you want to know how the earnings are going to be going up over time, and you want to know how much are you actually paying for that dollar of earnings. So if you look at this chart, you go right down the list. Price to earnings, the latest is 13.9. That's next year's. The 15-year average is 16.4. I won't read all this, but as I said, price to book, price to cash, price to sales, price to earnings growth, that's the PEG rate. For those of you that follow that, that's a pretty good indicator. And then finally, the dividend yield, that's even higher than it was for the last 15-year average. If you take a look at profits here, you get an idea of how much they dropped. That's principally because of the banks that struggled during the financial crisis. So that's right in the middle of this chart. But we passed the record 2 years ago, and now companies in the U.S. Are the most profitable they've ever been. And what we're finally seeing after years of relentless cost cutting is top-line revenue growth, meaning they're selling more watches, they're selling more product, and because of the relentless cost cutting, that incremental increase in your revenue drops right to the bottom line in many cases. So that largely accounts for the big increase in profits. Unfortunately, compensation to workers as a percentage of profit is the lowest it's been since the early 50s. So that's a problem as the nation struggles with income inequality. But the good news is profits are setting yet additional records. We know now that 61% of the profits for the S&P 500 come from outside the United States. Pretty interesting, when I first started doing this for a living in '75, only 14% of the profits of the S&P 500 came from overseas. Now it's 61%. And that's my favorite answer when people get political on me and are ranting and raving about this or the other. Most of the people in the world are oblivious to our political process. Half the people in this country can't even identify their congressman. So there's a limit to my enthusiasm about the political debate and its impact on profits. The kid buying that quarter pounder with cheese in Indonesia, he's fueling McDonald's profits. Over 72% of their earnings come from overseas. Just as an aside, I just had to say this. Some of you know that I went to Vienna to school, the European School of Economics, University of Vienna. Didn't know any German when I got there, and one of the first phrases I learned was Viertelfunder mit Käse. So how good are the Germans here? That's quarter pounder with cheese. Viertelfunder mit Käse. I did learn other German as the time went on. So this is an interesting chart because we're looking back a little bit on profit and we're looking a little bit ahead. These come from the Bloomberg consensus. I like Bloomberg estimates. They take the top 800 analysts in the United States. They throw out the bottom 10 guesses, the top 10 guesses, and come up with what they call consensus forecast. So look at 2012, $103 in earnings. Earnings are up 7% this year. But the reason why the market's doing so well, so professional investors, they don't care about current. We look into the future. And if you look into next year, profits of $122 for the S&P, that's a 10.7% increase from this current year. We get anywhere close to that, the markets are going to do well. If you go into the next year, and this goes out a little bit, 2 years, look at the estimates for 2015, $135. For all these years that I've been managing money professionally, when we emerge from sluggish growth, we're coming out of a recession, we're in a recovery phase of the business cycle. The minute we morph into the expansion phase of the cycle, guys like me worry about when is the Fed going to take the proverbial punch bowl away and start raising rates. This is one of those few times in my professional career that I get to tell you that we entered the expansion phase of the business cycle in 2011, June of 2011, as I showed you on the chart, and yet the Fed's telling us that they're not going to raise rates until at least the end of 2015. If you look at the futures market in Chicago, as people place their bets on when the Fed's actually going to raise, there's a 50% chance that they're not going to start raising until 2016. Now here's why I'm telling you this. The Fed's caused all but 2 recessions in current history by raising rates to reduce the inflationary threat, and they wind up putting the country in recession. We've only had 2 downturns since the end of the Second World War where the Fed had nothing to do with it, right? So guys like me that we're in the expansion phase of the cycle, I immediately start obsessing about when the Fed is going to raise rates. So 2015 into 16, that's an eternity for what I do for a living. And I know that on average, the Fed is going to end the party. And it's not the first time that the Fed raises rates. The attitude on the street is, oh, you guys are finally doing something about inflation. It's typically the 3rd time that the Fed raises, the attitude on the street shifts to, you must be really worried about inflation, you keep raising rates. And then the markets tend to sell off. So folks, I'm not trying to be a cheerleader here for stocks, because I think we have some significant problems to deal with, but I see pretty good skies ahead for the next couple of years for equities, because it's all about interest rates and earnings. If earnings stay low, and I'm showing you the profits are supposed to go up 10% a year the next couple of years, and we're at reasonable valuations for stocks, that tells me that there's good times ahead. So we're trying to take a stab at forward earnings here. The 15-year average for forward earnings. Let me back up. There's 2 ways to talk about earnings, trailing and forward. Trailing, pretty interesting from a historical context. I'm a little bit more interested in forward earnings. And yeah, it's a guess compared to what has been, but it's a great way to get a sense of which way we're going. So the 15-year average on the left-hand side here is 16.4 times earnings. That's the 15-year average. So for the full forecast for this year, we're at 15.2 times earnings. But more to the point, you factor in the estimate for earnings for next year, and we're under 14 times earnings currently for the stock market. So when we talk about a PE of 13.7, for those of you that are good at math, the reciprocal of a PE is a price-earnings ratio. So here's the idea. If you look at the earnings for this year of $110, divided into the S&P as of a week ago at 1683, you get a yield of 6.58%. Here's why I'm telling you this, of course. You want to compare and contrast the earnings yield to the 10-year Treasury yield. You can take $1 out of your pocket right now and get a little less than 3 cents of interest off the 10-year Treasury. You can take $1 out of your pocket and go into the stock market and get 6.58 cents of earnings, right? Here's the part I want you to remember. 6.58 is a bigger number than 2.9, okay? So whenever you see the spread widen, as you do in this chart, the market becomes even more attractive. Now, go back to the left side of this chart, 1990, right? And look at the narrow gap between the bond yield and the earnings yield on the market. Then look what happened in 2001. The bond yield became higher than the earnings yield number. Now, big money's unemotional. It's going to go to the higher number, right? So as a result, people sold stocks and went into the bond market. And now the gap is very, very high. So, of course, there was an exaggerated gap during the financial crisis, but look, the trend is your friend. Look at the last year now. The gap continues to widen, even as the 10-year Treasury went up from 1.6 in April to it's 2.7 roughly right now. Even though the yield has gone up, because earnings have gone up faster than the yield has gone up, the gap between the earnings yield and the bond yield is very, very high right now. That provides fundamental support for stocks as investors realize that 6.58 is, in fact, a bigger number than 2.9. Profit margins are near record highs. Consider that the average for profit, this is every dollar of sales, how much money do you make? The average since 1952 has been 5.9 cents of profit for every dollar. Now it's quite a bit higher than that, 9.3 cents of profit for every dollar of sales. Profit margins are high. No doubt as competition picks up, the margins will come down a little bit, but that accounts for the valuations for stocks. On almost every basic valuation measure, stocks look fairly attractive. The risk-on, risk-off trade may be fading. That's great news for us. So by that I mean, after the financial crisis was over, big money would either go in or out of the market, and they would buy baskets of stocks, indexes, to get in or out. And stock picking had very little to do with it. And finally, what we're seeing is that it's becoming a stock picker's market again. This dramatically favors actively managed funds over indexes, and we've been seeing that many active managers are beating the pants off of the index funds, particularly in the large cap stocks, finally this year. So the risk-on, risk-off trade is fading, suggests that investors are zeroing in on the prospects of individual companies rather than making wide bets on the markets. Correlation, let me mention that before I go on. So many of you know that we study correlation theory. The English translation here is you want to buy assets in your account that move differently from one another. So we're constantly looking at how assets move relative to one another. Assets that move in lockstep have high correlation. Assets that have low correlation to one another, stocks compared to bonds is the best example, have a low correlation. But correlation now has fallen to 5-year lows. That's a good thing for the financial markets. It's a good thing for those of us that invest money because it brings the risks down in your investment portfolios. So industrial stocks we like because of the U.S. and European recoveries. They're forecasting 11% earnings growth over the next 5 years. Gotta like financial stocks, although at some point in time they'll peak out. The banks have gone a long way towards repairing their balance sheets. They're now getting a sense of humor back. They're worried less about the regulators. And we see the bank stocks continuing to help lead the markets. As I mentioned earlier, Tier 1 capital, that's a big deal, is now at 13%. You got to like healthcare stocks now because of the greater coverage under the new legislation. And then finally, tech stocks. Tech stocks have been out of favor for a while. The tech stocks now have a PE of 13.5 times earnings compared to an average of 19 times earnings since 1986. Look at Apple as an example. Apple's selling for just 11 times next year's earnings. Sure, it's a pricey stock, but what a wonderful franchise for 11 times earnings. If you look at my list here, these are all, of course, large cap stocks. Some of them are in the value camp, the industrials and the financials and the healthcare and the tech sector representing the growth stocks. The most interesting thing about this chart is the conundrum that it shows. What we're showing is return by style this year. So most of you are familiar with the 9 styles according to Morningstar. The top row is large cap stocks, middle row is mid caps, bottom of the small caps. But take a look at the large cap value, right? Outperform large cap growth. And yet on the bottom, small cap growth has outperformed small cap value. One of the reasons for this is Apple Computer's decline this year represents 14% of the NASDAQ, a large percentage of the growth stock category. The next chart gives you an idea of the buying opportunities. So for all the money that I've made myself and for clients over the years, I've tried to get a bargain on what I buy. The beauty of that is they may stay a bargain, might become a better bargain, but it's hard to look stupid later if you cared about valuation, if you bought it right. So as many of you know, over every rolling 20-year period of time, large cap value has outperformed every other area. In the old days, I used to give entire speeches on the tortoise versus the hare. I got so annoyed after a while of newbies coming in my office wanting me to bet on some fast rabbit. And folks, as y'all remember, the turtle won the race. Make slow, steady, methodical progress year in, year out. Don't get waylaid, and you'll outperform every other category. So always keep your eye on the prize. Large cap value over long sweeps of history have outperformed every other category. Now here's what you're looking at. We take current PEs of the 9 styles and divide them into their 20-year average PEs. And all we're trying to do is figure out how to bottom fish, okay? So look at the bottom row, and you can see that small cap value stocks, wow, look pretty expensive to me, right? They're selling for quite a bit more than their long-term average. Take a look at large cap growth stocks. That looks pretty tasty to me, selling for only 79% of their long-term average. And of course, we argue at the firm about PEs being exaggerated in the growth stock area in the late 90s. But having said all that, you get a pretty good sense of where the bargains are. And I've always tried to migrate towards what I could get a deal on. Might stay a deal, might become a better deal, but you tend to do well as an investor if you focus on not just what's done well recently, that's how most individual investors do it, but to focus on the long term and try to figure out where are the bargains in the markets. And in my opinion, it's clearly in the large caps. I've always liked large value. Most of you have the largest weighting in large cap value in your portfolios. But I suspect that we're going to start tiptoeing over to the growth stocks this next year. The first half of a business cycle, investors tend to favor the companies that they know are going to survive. And then everybody gets courage because their portfolios are doing better, and people tend to migrate and tiptoe over to the more aggressive areas of the market. And I think the growth stocks have some pretty good legs. So this chart talks about correlation theory. As I mentioned earlier, bonds have a fairly low correlation to stocks. So if you spend some time and you get home and look at this chart, look at the low correlation between large stocks, and any kind of bond pretty low. So the idea on bonds is that if stocks get hurt, bonds tend to do well, and vice versa. Now, jump you quickly to the graduate school level, we know inevitably, as inflation starts picking up, that we'll have to introduce non-traditional asset classes to reduce your risk, because the correlation between stocks and bonds in a more inflated economy will start to rise. So there's only three ways to get there: Treasury, inflation-protected securities, real estate investment trust, and commodities. So we put a little bit of that in some of your portfolios. Haven't done much work in that because inflation really hasn't gone up much yet. But that's the way to reduce correlation. It's a risk technique. We're constantly trying to figure out ways to reduce the risk in portfolios without sacrificing return. The holy grail, of course, is figuring out how to reduce your risk and increase your return. That's harder than it sounds. And every other variation of that same motif. We're always trying to reduce the risk. We think offense takes care of itself most days, but the risk measures do not. In recent years, in the international markets, investors have flocked to the emerging world. That trend reversed this spring, as I mentioned, as interest rates rose in the U.S. The relative outperformance of developed markets has been greater than at any time in 15 years. So that's a lot, right? The developed markets are up 12% this year through August. Emerging markets are down 13%. In the past, the U.S. has weathered storms in the developing world. Mexico, 1994, Asia, 1997, Russia, 1998, without going into recession. On the other hand, recessions in the U.S. have almost always led to more severe ones in the emerging markets. As a firm, we have a very small exposure, less than 3%, to emerging markets, and we've recently reduced our exposure even more. So this is a pretty dramatic slide. You take a look at the top line, that's developed markets since the beginning of this year. The bottom one is I should call it the submerging markets, down 6, and that is in aggregate. The emerging markets as a separate category are down 12. So here's the problem. In many emerging markets, they've borrowed money in dollar terms. And when their currencies go down, it's harder to pay back. It takes more of their currency to pay back in dollars. So they've been raising their interest rates to try to stabilize their currency, and that weakens their economy. So countries like India, Turkey would be another example, where they're struggling to pay back their dollar-denominated loans, and I don't see that ending anytime soon. The second problem that you have in the emerging world is that the U.S. is inevitably going to raise rates. And when they do, that'll make the dollar more attractive, will make it stronger. Dollar's still up about 5% this year relative to the euro, a little bit less against the yen. But a stronger dollar makes it harder when you repatriate your earnings back to the U.S., makes it harder to make any kind of money. So we're a little bit worried about the emerging world. It sure looks like a buying opportunity, but I'm a little bit hesitant to commit any kind of meaningful money, particularly in retirement accounts, because it's a pretty wild asset class. But this gives you an idea of divergence. It's a lot in a fairly small period of time. So I want to shift over and talk about the bond market just for a little bit. Bond yields, as you know, have been unsustainably low. Some reversion to a more reasonable level makes sense, in my opinion. I brought this up last year. I'll mention it once more. There are cyclical patterns in interest rates. They last 4 to 5 years. And then there are long-term secular trends. Right? Think back August 1980, Paul Volcker, Ronald Reagan. When they write the economic history book, that's what they're going to be pointing to. Very famous words Ronald Reagan said that morning: if not now, when? If not us, whom? Right? So they decided to break the back of inflation, created one of the worst recessions since the Depression, and it worked. And what's been going on for the better part of 33 years is that interest rates have been coming down. Right? So these are long-term secular trends. So it's a pretty easy call to make that, hey, we're just bouncing along the bottom here. Since May 22nd, rates have started to come up. I'm not suggesting they're going to do anything like this, but on a secular basis, the game is over, right? And that calls into question asset allocation, correlation theory, and a host of other issues. So having said that, the secular pattern is clear. The cyclical pattern is less clear as the economy continues to struggle to hit some kind of reasonable rate of growth. My guess is that interest rates are going to go up just gradually. Been a tough year for bonds. The Barclays U.S. Aggregate Bond Index, as you can see on the chart, is down 2.8%. Yields on the 10-year jumped, as I mentioned, from 1.6 to almost 3%. There's only three ways for inflation to go up, right? And as a result, there's only three ways that interest rates ultimately go up. And everybody needs to be clear on this. It's easy to explain. Wages, commodities, and capacity. There's only three ways that inflation goes up. So start with wages, right? The average family hasn't kept up with inflation since 1991, right? Wages have dropped 6% on average since the financial crisis began. With unemployment as high as it is, I'm hard-pressed to understand how wages are going to do one of these. Commodities, there's another example. Think back to the summer of 2007. Corn was selling for $9 a bushel, right? Check it out now. It's a little over $4.50 for a bushel of corn. The only commodity item that has gone up in dollar terms in the United States this year has been the price of oil, $108 the last time I checked. So without a big increase in commodities prices, producers aren't going to pass on those price increases. And then the third one I mentioned just briefly, capacity utilization. We're just below 78%. And at some point in time, this is the amount of plant and equipment being used in the United States, we'll start running out of obsolete equipment and we'll have to replace what we have, and business spending will get back into a normal cycle, and that will be inflationary. But the fact remains that growth in the U.S. is moderate and inflation remains tame. And it's almost back to the Goldilocks economy that we remembered in the mid-90s. Stocks did wonderful for 5 years after that. So these forces should limit the increase in interest rates. The sell-off in bonds, in my opinion, fully reflects an end to the bond buying program. Check your bond funds last week. So I don't want you to look at your stuff all the time, but the average bond fund was up almost 0.2% just last week. Bonds did great even yesterday. So the bond market's coming back a little bit, but bonds still make sense. So you got to have safe money in your account. You want to make sure that no matter what comes down, you've got part of your money, you can get it no matter what, right? That's the goal for safe money. So you want to avoid doing two things that we see as trends in the markets that I think are going to end badly. One is going into a lot of junk bonds. Now, we have some lower quality bonds in the portfolio, but we tend to draw the line at junk bonds. And when we look at trades, we're constantly trying to analyze what's the upside versus the downside. Now, think of this in the junk bond market. Your upside is maybe a couple percent more. And let me remind you that junk lost a quarter to a third of its value in the financial crisis. This is your safe money we're talking about, right? So what sense does it make? It doesn't make any to me to go after the garbage in the bond market just to eke out a couple more percent when you're going to get your clock cleaned in the next downturn. And then the second issue is easy to explain. Investors are chasing yield by going out longer term, right? That's also a bad idea. So you want to remember the math, and everybody needs to memorize this one because it's important. Say it again. You multiply the change in interest rate times the duration of your bond portfolio, and that explains price movement. Most of you in this room with us have bond durations of roughly 4 years. So what that means in English is if rates go up 0.5%, you multiply 0.5 times 4, and your bonds are going to go down 2%. Okay? Now, we use the other example on the right-hand side just to exaggerate the point. If you have a bond that comes due in 25 years, you got a problem on your hands. You multiply 0.5 times 25 years, and you're going to wave goodbye to 12% of your bond money. That's your safe money now. So what's been happening in many of the bond funds that we use, they've been shortening the durations from 5 years to 3.5 years. The shorter the duration, the smoother the ride. And the last point I'll make on bonds is to get the sense of what net means, right? So on an average corporate bond fund, the yield is roughly 3%, give or take. So if interest rates go up a half next year, you're going to see that bond fund lose 1.5 to maybe 2% of its value. But it's the net that you care about. CDs pay 0.4%. My guess is we're all going to do 1%, maybe 1.5% on our bonds over the next couple of years. And remember that a rising tide lifts all boats. So that as interest rates go up, these bond managers are re-upping almost on a daily basis to higher yielding bonds, and that'll force your yields higher. But please don't abandon your safe money because just basic common sense says behave yourself with almost half your money. I want to spend just a couple of minutes talking about quantitative easing by the Fed, what it means to you, what it means to the bond markets, and what it means to the economy. So start from the beginning. It's the third round of bond buying that the Fed has launched. Quantitative easing, we call it QE3. It's aimed at boosting economic growth, of course, by lowering long-term interest rates, which the Fed hopes will increase spending, hiring, and investment. Since the Fed began the latest round of bond buying, $85 billion a month, the unemployment rate has fallen from 8.2% to 7.3%, and we've created 2.2 million jobs, partially as the result of quantitative easing. Now, the Fed bond buying has become almost a daily obsession in the markets. The prospect of a shrinking the bond purchases have already moved interest rates higher. The Fed's going to take us off the bond buying once the patient's off life support. Most folks think that's going to happen by the end of December. Ultimately, investors will see the end of bond buying as a positive as people realize the economy is able to move on its own 2 feet. And then finally, the answer for long-term investors is not to avoid risk. It's to be properly diversified and to invest in equities. Invest based primarily on valuations, buying assets that are cheaply priced and are likely to rise rather than momentum, which normally has gotten me into trouble. Stay balanced, practice humility. Many of my employees will tell you that I spend a fair amount of my energy preaching the concept of humility at the firm. As much as I try to learn about it on Sunday mornings, I try to practice it during the week. It's very difficult to forecast the future. What we can do is study how assets move relative to one another. What we can do is analyze the efficient frontiers to figure out what the right balance is for investment portfolios. Thank you. You know, I really appreciate everybody coming out this morning. You have a lot of choices of what to do with your day. Thanks for coming to listen to us talk about the markets and the economy. And folks, have a nice day.